Good morning, everyone. Good morning. Good morning. I hope that everyone is having a great day. Um, my name is Reginald Smith, and I am serve as a managing director at Sabre Finance. And so I'm super excited to be here with you all today. We're talking about one of my favorite topics. It's a buzzword during this time right now: loans, grants, money in general for business has been a thing. So we're going to dive into it. We're going to talk about um, how we're going to get some money for businesses and how you need to go about making that happen. And so I'm really super excited about doing that. First and foremost, I want to say thank you to the Calhoun County Chamber of Commerce for allowing us to be here today to speak to your members because we don't take it lightly and it's a huge opportunity for us. And so, on behalf of our CEO, Dr. Ray Morris and the Sabre Finance family, we want to say thank you. Also, we are a partner with the East Alabama Regional Planning and Development Commission right there in Calhoun County, and that's where our second office is. And so I sit in that office as well. And so to our partners there, Frank and Lori, we say a big thank you for all of us helping us to bring this together. So we're really super excited about being here today. So I'll tell you a little bit about me and how I function in these sections and webinars and things along those lines. All right, here we go. So my name's Reginald Smith. Again, I've been in banking for a little over a decade. I know I look like a kid, but I've been around the block a few times. And so I've been around, I've done this, and I've seen businesses walk away and not be able to get funding. And I've seen businesses be able to get funding. So I worked for four of the largest top 40 banks in the United States. And I saw a lot. And so my last position, I was a commercial lender. And what that means is I primarily did loans from businesses who had annual revenue sales from a million up to sometimes $50 million in annual revenue sales. And, you know, I saw a lot and learned a lot. And now I'm in the nonprofit space to be able to take that experience and be able to provide it to some of the micro enterprises that a lot of the chambers serve on a consistent basis. Businesses that make less than $500,000, businesses that make less than $100,000 a year. While we're still able to service those larger businesses, they can pretty much go where they need to go to get what they need. But a lot of that information sometimes really passes over or doesn't get passed down to some of the smaller entities. And so again, we're going to talk big, small. The information that we're going to give today is going to fit for everyone. So, as you can see my slide, we're talking about how to get a business loan for your company. Football season just kicked off, so it was a big weekend in college football. NFL has been going on for a few weeks, and so it's fall. It's nice and crisp outside, and I figured what a better way to kind of guide us through and using quarters. And so I thought that was cool. And also, it's a business term. So right now we're in the third quarter. Excuse me, we're going over this ending third quarter today and getting ready to start the fourth quarter. And so a little play on words, but I hope you guys enjoy it. So we're going to talk about first quarter is going to be, do I need it? Do I need a loan? Then we're going to transition into the second quarter is why. Why do I need a loan? Why? What's my reason? You have to have a reason for a loan. That's very important. Third quarter is, can I get a loan? That's a real question that we have to answer. And the fourth question is going to be, where do I go? Where do I go get a loan from? So again, I don't like these to be boring. I like them to be interactive. And so if you have a question, please put it in the question and answer box. If you don't understand something that I'm saying, please go ahead and drop it in there so that we can make sure that we're addressing that for you so that we don't get lost and we don't leave anybody behind. But we will have time at the end to make sure that there's an opportunity for you to ask specific questions because every business is unique. So, as we get started, businesses are broken down into a couple of different categories. So, you have service based businesses, you have professional services type of business, and then you have your manufacturing and things along those lines, right? So, all of us have different needs, all of us have different reasons of why we could think that we could get along. So, Let's jump in. First reason, do I need a loan? And so again, you have everything from your independent contractor, which is just an individual who may have its own company that's working with another entity, or it may just be a sole proprietor who's working under someone else. And then you have your startup company. We hear that term a lot, and that's just anybody who's really getting going, getting their feet wet, and trying to get things up and running for their company that they're trying to start. They haven't started yet; they're working to get that started. Or you have your corporation, your LLCs, your incorporated businesses, or again, you have your sole proprietors. And we have to ask ourselves, do I need it? Um, Here's some questions to think about when you go down that road. When you go down that road and you start saying, you know what, I think I need a loan. Here's some questions that you want to ask yourself. Is your business growing? That's the first question. And when I say is your business growing, what I mean by that is, are you beginning to have more work than you or your current staff can handle on your own? Are you beginning to have more work that you or your current staff can handle alone? Great question. Do I have an equipment need? If I could do more with a larger piece of equipment or a additional piece of equipment, do I need that for the loan? Is that something that I need to help my business go, to help my business to grow? Do I have an inventory need? Now, this one is interesting. There's seasonality to this because you may be a business who makes the bulk of your money during the holiday season. Maybe you make Halloween, harvest-based Thanksgiving and Christmas type of items, t-shirts, ornaments, different amongst things, and you need to buy a boatload of or really stock up on things to for that season every year. And you can get it at a cheaper price if you buy it in larger quantities. That's a real need. That's a real need. Will you have hiring activities? Will you need to hire people? Is it coming to the place where I need to bring on additional staff? Is my additional staff going to cost me money? Well, the answer to that is yes. You're going to have to pay their salaries. You're going to have to onboard them in whatever way, buying them a laptop or buying them whatever uniforms or whatever they need. So there's expenses that come along with that. Also, do you need to refinance debt? That's another one to really think about. Do you need to refinance that? And we'll get into that here a little bit deeper in a minute, but just kind of wanted to throw that out there. So again, um, that's a really good one that we kind of wanted to talk about. So again, we're talking about how to get a business loan for your company. And now we've transitioned from, we talked a little bit about, do I need a loan? And now we're going to transition to, should I borrow money? Should I borrow money? Why should I borrow money? So, according to 40financial.com, it said the top three reasons company apply for loans, for business loans, are business expansion, operating expenses, and refinancing of business debts. I'll say that again. The top three reasons companies apply for a business loan are business expansion, meaning that you're growing, operating expenses, day-to-day operations, lease payments, payroll, etc., and refinancing of debt. I thought that was very interesting. So, well, you may be saying, well, are those the only reasons that I should borrow money? No, it's not. So again, we talked about payroll here. We talked about equipment. We talked about inventory. Relocation is a reason that you maybe you've been renting from a landlord and now you want to buy a building. That's a reason to borrow money. That's a good reason to borrow money. I'm moving through this rather quickly, so if you have any questions, again, please go ahead and put them in the Q&A box. Just because I want to be able to get to your specific questions, and I have a specific place that I'm going to spend a little bit more time on to make sure that it really drives home. But I want you to understand that one of the most important things that we have to ask ourselves is, will the loan help me to make more money? As a lender, as a business owner approaching a lender, it is imperative that you are able to answer this question. Will the money that you are borrowing help you to make more money? Lending institutions want to be able to help you to grow and to see an uptick in your revenue sales. Most of the time, a lending institution is not lending to you for your business to stay the same. It's very important. Very, very important for us to understand that. We're not lending money for you to stay the same. We're lending money for you to be able to grow, for you to be able to expand into. So I think there are different types of loans. So a lot of people say, well, what about lines of credit? And what about the difference between a loan and a line of credit? So I'll answer that since we're here. We're talking about why should I borrow money? A line of credit is used for a short-term need, specifically with contractors, but most of the time that contractor term can be a little used loosely. So maybe you're a caterer and you normally get half of your money up front, and then you get the remaining on the end when you show up to the job. So you do weddings, you do retirement parties, but you also do corporate events. And you had a large corporate event to come up, and that corporate event cost you $1,500 to put on, but you're going to make $5,000 off of it. So that $1,500 has to come out of your bank account, or you have to have another avenue to be able to supply those funds. If you have that money in your bank account, you may need that money for something else. And if you use that money, now it's put you in a tough spot because now you're waiting on that larger corporation to cut you a check. And maybe they only cut a check at the 30th of every month, and it's the beginning of the month. And so now what are you going to do? Well, a line of credit can help you in that interim time to continue to operate, even though you've only had that one job, so you don't have to stop. So now you still have cash in your account, and then when you get paid from that job, you just take the $1,500 that you were gonna that you used anyway, pay that off, and then move forward. So that's a very critical reason of that's a very critical product for some business owners. And so a loan is going to be something that's traditionally over a longer period of time. Loans are going to be your equipment financing, your working capital financing, your build out of a new building that you just purchased project. So I like to throw that out there because people oftentimes use that your line of credit can be closed or it cannot be renewed from a bank's perspective because you're not using it and paying it off. Using it and paying off. They says it has to have a cleanup period. That's kind of what the bank likes to call it. They want to see that line of credit go from you being having dollars on it to being paid off at least every 30 days. So that's very important. So again, will the loan help you to make more money? So let's keep moving. Third quarter, can I? So we're going to spend a little bit more time here because that's based on different things. And I'll start with the traditional way, and then I'll work my way backwards into the special cases. The traditional way of actually being able to tell whether or not you can afford to borrow money is to look at your net operating income. What that means is whether on your taxes, at the bottom line on the front, on your profit and loss statement, if you're filing, I'll get specific. If you're filing as a corporation or an LLC, if you're filing separate corporate tax returns, it'll be at the bottom where you see profit or loss, that number. So whether you made money or lost money, that number is used to determine what's called your debt service coverage ratio. Debt service coverage ratio. That's DSCR, debt service coverage ratio. If you have a negative number there, that means you didn't have anything left over. Now, that doesn't face value mean that to a lender because you may be negative $1,000 and you may have written off $3,000 in depreciation on your tax returns. Now, this gets a bit technical, and this is why I wanted to slow down on this, because if you have a negative number of 1,000, you wrote off $3,000 in depreciation, you wrote off another 2,500 in taxes. Well, we can add that back to that negative number, and that actually puts you at a positive number because those technically weren't things that you, for lack of better words, paid. So we can actually add those numbers back, and you will have those numbers to use throughout the year to service the debt that we're trying to get. So we're going to figure out that ratio on your end to see what your net operating income is. And then we're going to take the debts that you currently have as a business. We're going to take the debts that you currently have. This right here can change everything as it pertains to where you're looking for lending and how you're approaching lending. Okay. So this is very, very important. So, and I'm taking my time, and I hope that you all are willing to jump out there and ask a few questions in this one, because it's going to be critical. Because as you approach a lender, if you understand this, that builds credibility with that lender, and they realize that you understand the process that they have to go through to be able to make an assessment on whether or not they're going to lend money to you. So again, we've taken what you have on your tax returns. Now we're going to take the debt payments that you have every month for your business. So whether you're financed equipment already, whether you have a lease payment that you have to make, or whether you have all of the different expenses that you have on a monthly basis, we're going to look at those from a lending perspective, and we're going to take those monthly expenses that you have, and then we're going to add the proposed loan in. And that proposed loan, that debt for the proposed loan is going to be looked at. Okay, I'm trying to borrow $1 million. Well, that $1 million payment may be $2,000 or $3,000. So we're going to add that $2,000 to $3,000 in to what you're already paying, and we're going to take it and we're going to divide your net operating income, or what you had off of your tax returns, into that total number of things that you have to pay from an expense perspective. And if that number comes back at 1.25 or greater, then that means that you have, for every dollar that you make, you have a quarter left over. It's the easiest way that I can say that, 1.25. So you have $1.25 left over to be able to pay everything, and you have a quarter left to be able to pay some more. That is very critical. That means that you can handle your responsibilities on paper and take on additional debt. If that did not make sense, please jump in here and ask a question. I was just checking to check the question box, but so so that's the normal way of doing that. So we're going to look at your tax returns, and so that's why it's so very, very important. That's why it's so very, very important. And so that's very, very important for it to be able to figure that out. So I have a 3-year-old and a 5-year-old at home. He needed a jacket. So excuse me. So um I have to make sure, as the business owner, that I understand debt service coverage ratios. If you don't understand debt service coverage ratios on your own, then please reach out to myself at Sabre Finance, or you can reach out to the Small Business Development Center in your area. Alabama has a great small business development center network, and they can help you with this at no cost. And so this will be fantastic for you to be able to take advantage of and understand where you are before approaching a lender. Now, say I'm a startup and I don't have tax returns, or this is my first year and I've only been in business for 11 months and I just don't have tax returns yet. Well, this still can apply to you as well. It's important to be able to keep records of your sales once you get started. And so once you get started, you should automatically start keeping track of that. Now, you can reach out to one of the entities and figure out some free ways for you to be able to do that. And that's not an issue. But we need to be tracking it, even if you're writing it down on a piece of paper. I've done a loan for a business owners who was literally writing their transactions down on a piece of paper from the time that they started. They had only been in business 18 months. So it's not about how fancy it is. It's about actually being able to take those numbers and document those numbers. What are you making? What are you spending? And we can help you navigate through that process. And so maybe your loan as a startup is only $500, and we can tell whether or not you can afford a $500 payment based upon what you're tracking. But I want to say the most important thing to be able to talk about what you can afford and what you can borrow is going to be accurate bookkeeping. So I can't stress enough, if you haven't already experienced that with PPP applications and economic injury, disaster loan processes, any grant opportunities, people are going to want to know, how are you managing your funds? And so bookkeeping is critical for you to be able to do that. So there is hope. If you're a startup, a lot of people say, well, I'm a startup, so nobody will be able to help me. Well, I think there's a way to start up. I think one of the, and this is just my personal opinion, having a business loan at the beginning, I think it creates a degree of pressure on the business owner. So I think that makes it very difficult for them to navigate through that process. And so I think you would definitely want to make sure that you have the ability to take your time and get a business loan that you can afford. All right, fourth quarter. Where should I apply? Now, this may seem like a very weird question, but it's one that I found that helps a lot of business owners to really be able to get a grasp on what they should do and where they should go and why that matters. Because just going to your bank, depending on where you bank, does not automatically mean that you're going to be able to get access to capital. And if you get declined, it doesn't mean that they don't like you. And so let's not take these things personal. I think we have to understand a broader picture of being able to see into the lending world and really obtain a business loan. So here's a list of lending institutions in the state of Alabama. If you'll take a look at this list, you'll see that this is not the whole list. This is just part of it. But you'll see banks that you may be familiar with. You may not be familiar with those banks. You may have accounts at these banks. These banks are headquartered in Alabama. That's why I pulled them up. And when you begin to look at an assets, you see financial institutions, headquarters, and assets. If you look at the asset column, you'll see that these entities are very large as it pertains to assets. Most of our small businesses have less than $1,000 in their bank accounts. Okay. Deposits, what you carry in your bank, are goes into this asset number of what a bank has. Okay. So it's very important to understand the size of the bank that you bank with so that you can understand the how they're going to view you. One second. Okay, I'm back. So once you understand how they're going to look at you as an individual, as a company, based upon their asset size, you can better know who you need to go to or if you need to go to a bank at all. So how this is how we're going to do this. So Regions has a lot of zeros. behind where they're going. So if we look at regions, we're talking about $140 trillion in asset size. Did I get that right? Let's see here. 100,000 million. Yeah. Excuse me, billion. $140 billion in asset size. BBVA companies, $100 billion in asset size. Will drop off 11 billion, 6, 3. And so when we're comparing, excuse me, when we're comparing ourselves to how much money we have on your $1,000 may be all that you have, even if you have $1 million in their bank. And some of these lending institutions, that's not a lot of money for them. Um, you do get preferential treatment based off of how much money you have in the bank. I worked for the bank for a very long time. High net worth and high value business owners and high net worth and high value clients, there is a preferential treatment that's given to you. Doesn't mean that you don't have to go through the lending process. It just means that they're more likely to work with you because they can use your money as collateral at that point. Most startup companies or most smaller entities, you don't have collateral, meaning you may not have anything to offer to help the bank feel more comfortable with doing your loan. But if they have your cash in the bank and you want to borrow $1 million or you want to borrow 500,000 and you have $2.5 million in the bank, then that makes them feel a lot more comfortable being able to do that loan. So you may have heard stories about it's easier for certain people to get money. Well, we have to look at the entire story to be able to figure out what is the real issue or the real story behind how that person was able to navigate that lending cycle. I personally recommend that you have one bank. That is extremely important, having one lending institution, unless there is a specific reason that makes sense for the business of why you need another bank. You need to have a relationship with a lender, one lender. If you come to me or have come to me as a banker when I was in banking and you had 4 different bank accounts with 4 different companies and one of them was mine, and I'll add insult to injury, my account had the smallest dollar amount in it. That tells me that you're not vested in the relationship to build a relationship with our company. Now, I want to earn your business, so I'm going to ask you things like, well, why do you have 4 other institutions? Are they offering you something that I'm not offering? Some of you may have had this conversation with a banker. Some of you may not. Some of you, maybe you have this conversation one day. And what they're saying is, why don't you bring all of the money to us? And you may say, well, I don't want to do that because I've been told not to keep all of my eggs in one basket. Unless you have more than $250,000 in that lending institution, that's the only time that you should start considering to move money, because that's where your FDIC insurance runs out. FDIC insurance is a federal entity that insures the money in their bank up to $250,000 per tax ID or per social security number. So you can have 4 accounts, but as long as you don't have over $250,000 in those accounts, you're covered. Then you should start looking into that. But even in that, you want to be with someone that you feel like I can keep multi-million dollars in that bank and they won't go under. But if you don't feel comfortable that way, then at that point we can start exploring other options. But until then, we want to have one relationship with one bank. Why, Reginald? Why do I want to have that? Because now that entity, you can go to them and say, I've been banking with this entity for 5 years. I've been in business for 5 years, and I have all of my business here. All of the funds that I have are with your organization. I need you to see my vision and to work with me. That gives you leverage when you bank with one institution. So, based upon your deposit size, you want to look at and you can just do a quick Google search. You can do Alabama banks and type in asset size, ASSETS, asset size. And once you look at that bank's asset size, what you'll be able to do is you'll be able to scroll down and look at where the asset sizes are and if they're in your area and whether or not you're going to be able to do business with that company. Now, I'll tell you up front, a lot of the smaller banks don't have a bunch of branches, so it may not be convenient for you. And it may not be the best online banking setup for you. But we're talking about getting a loan. And so, if this is something that's important to you, I highly recommend considering this process about looking at the asset size and doing your homework about who you're banking with. If you're banking with Regions, I like Regions. Actually, I have a couple of accounts with Regions. I never had any heartburn with them, but they have $140 billion in assets. And so you have to look at on if they're running their reports about where their assets are coming from, the $1,000 or the $500 that you have in the bank, it may or may not even show on the report that they pull. And you have to think about that. But if you pull a bank, Bank of Auburn or the Bank of Troy, who only has 800 million, that report may not be as long. And that's something that I didn't get the opportunity to share when I was at the bank. But I think that's something that now I'm able to share and give people the knowledge and empowerment to be able to go out and make a informed decision on how they want to go about borrowing dollars. And I think that's the most important thing. Another thing that you want to look into are SBA microlenders. And so SBA microlenders are partners with the Small Business Development Center. Excuse me, with the Small Business Administration. So that means that they have built a relationship with the SBA and they're committed to lending and providing business consulting services for businesses who need a loan $50,000 or less. And so that may be an option for you, especially for my startups. If you're a startup, definitely, I highly recommend that you Google and go to SBA.gov and look for the match lender and find the micro lenders. All right. Um, Lastly, you also want to look at community development financial institutions. So that's the last thing. I just forgot to mention that or put it in here, but community development financial institutions. And so you will look up CDFIs in Alabama, and those entities oftentimes have dollars to help in low income or um, low income census tracts. And so the last time we did some type of presentation, a lot of the East Alabama counties are qualified for things like EDA grants and federal funding. And so I would be interested to to see if you fit into those same categories as it pertains to CDFIs as well. And so that's what I have for that. I know I probably went through it a little fast, but I wanted to say that it's possible. It is possible to get a business loan. Um, Again, I don't see any questions and answers in here, but if you have any questions, um, please drop them in here. I wanted to leave enough time to do that, but do I need a loan? Is the first thing that we need to address. Do I really need a loan? Let's assess, do we have to borrow money at this time? Borrowing money just because I'm not really sure if things are going to get tight here in the next few months is traditionally not the way to go if you want to take out an additional loan. There may be extenuating circumstances, but that's just not the reason that we want to look at borrowing money. Why should I borrow money? Expansion, operating expenses, refinancing of debt. Maybe you went out at one point in time and you had to buy a piece of equipment and you went online to this company and they charged you 40% interest. And that was 2 years ago and you've been paying them on time and you make more money now. And maybe now you can come to another organization and you can refinance that and now you're not paying as much money on interest. Maybe you've borrowed and bought 4 or 5 pieces of equipment, and you're paying $1,500 a month, and then you can refinance and put all of those debts into one pool, and maybe you can save $1,000. That is a generating more money strategy. That is increasing your revenue or increasing the cash flow inside of your business by doing so. What can I afford to borrow? Look at those taxes. Again, we can help you with that, but take those taxes, look at where the profit or loss is. If you're a sole proprietor, that will be on your Schedule C. And you look at if you had a profit or loss, take the debts that the business has so far. So if you're paying anybody right now, any loans, what are those monthly payments? And you need to have a 1.25 when you come out of that. That means that you have $1.25 that you can pay. And where should I apply? Looking out for those entities if it's a bank, looking at the asset size, looking for micro lenders, and looking for CDFIs, community development financial institutions. And so if I had to give the overall broad perspective, that's what I would provide. There are a lot of unique one-off situations, and so I didn't want to get into a lot of different case studies unless you all wanted to navigate through that. But I think that that gives you a good baseline of really raising your percentages of scoring a business loan for your company. And so I'll leave my slides up here. And if anybody has any questions, I can jump back to where I was. And I'll actually leave a few more here. And but if not, then I can go ahead and close this out. Okay. All right. And so I don't see any questions coming through. And so I don't see any questions coming through at this time. And so what I will do is go ahead and end. And if you have any questions, feel free to reach out to the Calhoun County Chamber, or you can reach out directly to myself. My email is rsmith, SMITH, at Sabre Finance, like saber-tooth tiger, SABRE finance.org. And thank you.